Everyone wants to know the same thing right now. Is this the moment when an asset drops 50% from its all-time high? Your brain starts doing math. Your brain starts whispering. It says maybe this is the opportunity. But here is the uncomfortable truth nobody wants to hear. The question itself is wrong. Not because timing doesn't matter, not because price is irrelevant, but because the way most people are framing this question is setting them up to either miss entirely or get destroyed. I have watched this happen across multiple cycles. Smart people, people with real money, people who did their research. They asked the right question in the wrong way and ended up worse off than if they had done nothing at all. So let's reframe this. Instead of asking, is now the time to buy Bitcoin? Let's ask, what are the actual signals that matter right now, and what does the data actually say about this market? What are institutional players watching right now? And most importantly, how do you position yourself so that regardless of what happens in the next 3 months, you are still standing and still building wealth in the next 3 years? Because that is the real game. And most people are not playing it. Let me start with something genuinely underappreciated about this exact moment in Bitcoin's history right now. Right now, Bitcoin is sitting between $65,000 and $70,000. That is roughly 50% below its all-time high of $126,000, which was hit earlier in 2025. If you walked up to someone on the street in 2020 and told them Bitcoin would hit $65,000, they would have called you insane. 65,000 was an unimaginable number back then. It was the kind of price that Bitcoin bulls were mocked for even suggesting. And today, $65,000 is being called a crash. That tells you everything you need to know about where we are in market psychology. Because here is the thing, the data is screaming right now. Interest in Bitcoin is at multi-year lows. Crypto apps have completely fallen out of the top 10 on the Apple App Store right now. Google search volume for Bitcoin is down 2 to 4 times compared to peak euphoria. The retail investor who got excited when Bitcoin was flying past $100,000? Gone. Completely disengaged. ETF flows, which were massively positive when institutions were rushing in, have turned net negative on a monthly average basis. Think about what this actually means for your opportunity right now. Think about this. Bitcoin is 50% cheaper than it was at its peak, and there are dramatically fewer people interested in buying it. That is the exact opposite of how rational markets should work, and it is the exact setup that has preceded every major Bitcoin recovery in history. Warren Buffett has a version of this principle. Be greedy when others are fearful. Be fearful when others are greedy. It is one of those quotes that everyone nods at and almost nobody actually executes. Because when the fear is real and the price is genuinely down and the headlines are negative, it takes a completely different psychological framework to act. The crowd right now is not interested in Bitcoin, which historically has been exactly when Bitcoin rewards patience. This is the fundamental dynamic you absolutely must understand before making any decision. Now let us talk about the actual metrics that sophisticated investors are watching right now, because this is not just vibes and contrarian philosophy. There is real hard data here that you need to know. The first metric is the 200-week moving average. You take the average price of Bitcoin across the last 200 weeks. That is roughly 4 years of price data smoothed out into a single powerful number. It removes the noise. It removes the day-to-day volatility. And what you are left with is a long-term baseline that tells you something incredibly important about where fundamental value tends to anchor itself. In every single major Bitcoin cycle, the 200-week moving average has acted as a gravitational floor. During the 2013 crash, during 2018, during 2022, Bitcoin has always bounced off this level. Right now, that number sits at approximately $58,000. Bitcoin is trading at $65,000 to $70,000. We are above the 200-week moving average, but we are not dramatically above it. We are in the zone where historically long-term buyers have stepped in. This is the zone. And the second metric I want to show you is called the realized price. And this one is even more compelling. The realized price is derived from on-chain blockchain data. It represents the average cost basis of every single Bitcoin that has ever moved on the blockchain. It is essentially the average price every holder actually paid. This is significant because it gives you a real picture of market psychology. If the realized price is above the current trading price, the average holder is underwater. They are sitting on an unrealized loss right now. Right now, the realized price is sitting around $54,000. Bitcoin at $65,000 to $70,000 is above the realized price. The average holder is still technically in profit, but we are getting close. Here's where it gets really analytically rich. Across previous cycles, many analysts have identified the zone where the 200-week moving average and the realized price converge as the point of maximum fear and maximum opportunity. In the 2011 crash, these two metrics essentially crossed at the exact bottom. In 2022, a similar behavior. If history were to rhyme, the zone between $54,000 and $58,000 is where the opportunity gets most interesting. I want to be absolutely clear. This is not a price target. This is not a prediction. Markets are not mechanical. But these are the numbers that sophisticated investors are watching and that you should understand. Now I need to address the elephant in the room, because this cycle has been genuinely different in ways that matter. This is not 21E8 and it is not 2022, and understanding why that is true is absolutely critical. In previous bear markets, the pain came from inside the crypto ecosystem. The 21 AT speculation and over-leveraged positions. The 2022 crash was triggered by the collapse of Terra Luna and then amplified by the FTX implosion. This time is different. This correction is being driven by macro forces, by Federal Reserve policy, by global trade uncertainty, by geopolitical tension, and significantly by the unpredictable policy environment coming out of Washington. Bitcoin is currently correlating heavily with US tech stocks. When the Nasdaq gets hit, Bitcoin gets hit. That is a newer dynamic that reflects the fact that institutional money has now entered Bitcoin through spot ETFs. Institutions have risk management frameworks. When volatility spikes across their portfolio, they reduce exposure across the board. Bitcoin gets caught in that wave, even when nothing is actually wrong with the Bitcoin network itself. This creates both a complication and an opportunity. The complication is that traditional cycle analysis becomes less reliable when Bitcoin price is being influenced by factors that have nothing to do with Bitcoin fundamentals. The opportunity is that when those macro events create fear-driven selling in Bitcoin, the actual asset itself remains completely unchanged. The network still produces a block every single 10 minutes without fail. The 21 million coin supply cap is still mathematically enforced. The decentralization is still intact. The fundamentals that make Bitcoin valuable in the first place are completely disconnected from whatever drama is happening in Washington. There is a scenario, I want to be honest, this is speculated. But there is a real scenario where the artificial intelligence bubble experiences a violent correction. If that happens, the initial reaction in Bitcoin would likely be a sharp drop, fear across all asset classes, panic selling, possibly a brief window where Bitcoin trades at levels we have not seen in a very long time. And that historically is the kind of moment that creates generational buying opportunities. The COVID crash created that moment. The FTX collapse created that moment. These windows are rare and they reward those who are ready. Now let me talk about something that gets overlooked in almost every Bitcoin discussion, and I think it is the single most practically important thing you can take from everything I am sharing with you today. The people who have consistently made money in Bitcoin over the long term are not the people who timed the market perfectly. They are not the traders who called the exact bottom, and they are not the analyst who predicted the cycle peak. The people who built real wealth in Bitcoin are the people who understood the asset deeply, sized their position correctly, and held through multiple cycles without ever being forced to sell. That is the entire framework right there. They invest money they might need in the next 12 to 24 months. And then when the volatility hits, which it always hits, they do not have the psychological bandwidth to hold through it. They panic and they sell. Here is the brutal math on this. If you invest an amount of money that represents a significant portion of your liquid net worth, and Bitcoin drops another 30% from here, you will panic sell. I am not being harsh, it is human nature. You are not checking the price every hour. You are not lying awake calculating your losses. You are holding through the volatility because the volatility is not existential for you. And that patience is what gets rewarded in Bitcoin. Only 0.7% of people who bought Bitcoin and held it for more than 3 years are currently sitting on a loss. 0.7%. The other 99.3% of 3-year holders are in profit. That is a remarkable number. And it is not because those people are smarter or luckier. It is because time in the market combined with correct position sizing that allowed them to hold through multiple scary periods created that outcome. Now let us talk specifically about the DCA strategy, because I think it is the right framework for this exact moment, and I want to explain why it is not just a defensive move. It is actually an aggressive accumulation strategy. Dollar cost averaging means you buy a fixed dollar amount of Bitcoin on a regular schedule. Every week, every 2 weeks, every month. You do not try to time the market. You do not wait for the perfect entry. You just consistently add. The mathematical effect of this is powerful in volatile assets. When the price is high, your fixed dollar amount buys fewer coins. When the price is low, your fixed dollar amount buys more coins. Over time, your average cost trends to the lower end. But here is the strategic layer that most people miss. Right now, with Bitcoin between $65,000 and $70,000, you should absolutely be running your DCA. But you should also be maintaining a reserve of liquidity for opportunistic buying. This is what sophisticated long-term investors are doing right now. They are not going all in at current prices. They are not waiting on the sidelines. They are splitting their strategy and running both tracks simultaneously. You are positioned to win in multiple scenarios. Now let me address the fundamental question that should actually precede any discussion of price and timing. Has anything changed about Bitcoin itself? This is what truly matters. Because sometimes when an asset drops dramatically, it is because something has actually broken. The business model failed. The technology was disrupted. When Kodak collapsed, it was not opportunity to buy the dip. The underlying reality had genuinely changed. So what about Bitcoin? Bitcoin at $65,000 is running the exact same protocol it was running at $126,000. The block time is still 10 minutes. The mining difficulty is adjusting correctly. The node count is healthy. The hash rate, which measures total computing power securing the network, is at or near all-time highs. The 21 million coin hard cap is still mathematically enforced. Nothing about Bitcoin has broken. This is actually one of the reasons Bitcoin as an asset class is analytically interesting right now. In a world where artificial intelligence is accelerating a pace that is genuinely difficult to comprehend, there are going to be profound questions about digital authenticity. How do you prove that a piece of digital content was created by a human? How do you establish unique ownership of digital assets in a world where everything can be replicated instantly? How do you maintain a financial system that cannot be inflated away? The blockchain technology that Bitcoin introduced in 2009 is the only existing technology that provides cryptographically provable digital uniqueness and scarcity. As AI reshapes the economy, Bitcoin's core value proposition does not weaken, it potentially strengthens. I am not saying Bitcoin solves every problem. I am saying the underlying use case for a decentralized fixed-uply a resident store of value is arguably more relevant than it was in 2015. And that fundamentally changes how you think about a 50% drop. Here is something I want to be genuinely honest about. Nobody can tell you with certainty what Bitcoin is going to do in the next 6 months. Anyone claiming they know is either lying or they are delusional. Full stop. The macro environment right now is genuinely complex in a way that even the most experienced analysts are struggling to model. What I can tell you is what the data suggest about relative opportunity. Across multiple frameworks, whether cycle history indicators or on-chain metrics or sentiment data, the current environment has characteristics that have historically preceded strong Bitcoin performance. Does that mean it cannot go lower? Absolutely not. Bitcoin could test 58,000. It could test 54,000. In a genuine macro shock, it could temporarily go lower than that. You should mentally prepare for that possibility. The relevant question is not whether it can go lower. It is whether over the time horizon you are planning to hold it, those lower prices represent an opportunity or a catastrophe. And that depends entirely on your position size and your time horizon. The final thing I want to leave you with is this. Bitcoin is a long-term conviction play. It always has been. The people who have built meaningful wealth with Bitcoin are people who understood that holding through painful drawdowns was the price of admission. If you have never owned Bitcoin and you are watching this wondering if now is the time, start small. Smaller than you think you should. Set up automatic recurring purchases and commit to not checking the price every day for the next 12 months. If you already own Bitcoin and you are sitting on an unrealized loss, wondering if you should sell I would push back on that impulse hard. Unless your life circumstances have changed and you genuinely need that money, selling locks in that loss permanently. And if you have been accumulating coin over time and you are wondering how to think about this period specifically, I would suggest this is a period where slightly increasing your regular accumulation makes rational sense. The perfect moment to buy Bitcoin does not exist. It never has. What exists is a consistent approach, a correct understanding of risk, and enough conviction in the long-term thesis to hold through the periods that test your patience. The patience is the strategy. And right now, with Bitcoin 50% off its high-end sentiment at multi-year lows, patience combined with consistent accumulation is the same coin holders have made at every similar moment in this asset's history. If this video gave you value, smash that subscribe button right now. I drop deep dive content like this every single week so you stay ahead of the market. Hit the bell so you never miss an episode. See you in the next one.